Gold isn't near records right now. It's rewriting what the world treats as trustworthy, and the people who hate that story are trying to talk you out of what the tape is already saying. This move has been framed as emotional, temporary, just another fear spike, and the second the dollar perks up, you're supposed to believe it all collapses. But that's not the part that matters. And the part that matters is the plumbing. Because under the headline price, the market structure has been quietly forcing behavior, and that's why gold can pull back hard and still stay in a regime that doesn't look like a normal trade anymore. And before we're done, you'll have a clean near-term roadmap, the levels that matter, what confirms the next leg, what breaks the thesis, and the one calendar window that can turn a calm week into a violent one. And that's where the real pressure starts. Start with the raw context. Gold is sitting around the low to mid $4,000 per ounce, and it has already proven it can print in the mid 4600s. That matters because record levels aren't just bragging rights. Records change risk management. They change margin. They change option hedging. They change how institutions talk about an asset in committee meetings. And they change the psychology of everyone who missed the move and is now waiting for a perfect dip that never quite arrives. But here's the twist. The most important information isn't the record. It's what happened right after. Late December showed you the whole playbook in one brutal sequence. Spot gold pushed up around the mid 4500s, then dropped fast, over 4% in a single day, down toward the mid 4300s. On the surface, people said, see, bubble. But mechanically, it looked like something else. The exchange raised the cost of holding risk in precious metals by hiking margin requirements, and that forced the fastest hands in the room to cut positions, whether they wanted to or not. Not because they changed their mind, because they got their balance sheet changed for them. And if you understand that one detail, you stop confusing forced selling with the bull market is over. Because forced selling is often just the market taking a breath through a straw. Then January arrives, and gold pushes again, back toward the mid 4600s. That's the tape telling you the demand isn't a one-day headline. It's persistent, it's layered, and it survives stress tests. But that's not the part that matters either. The next detail is what flips the whole setup. The hidden detail is that the people calling this mania are watching the wrong battlefield. They're watching the screen price. The real battle is in the financing and the constraints around holding the position. Margins, roll dynamics, deliverable logistics, option hedging, and the difference between paper exposure and physical behavior. You don't need a cartoon conspiracy to understand why this matters. Markets are incentive machines. When an asset becomes a referendum on confidence, every big institution has an incentive to frame it as temporary while they manage their own exposures. That's not evil, that's risk management. But it does create a consistent pattern. When gold pushes into new territory, the narrative turns dismissive right when the structure is the tightest. And that's where the real pressure starts. Let's simplify the mechanism without dumbing it down. Paper gold, futures, options, swaps, sets the quoted price you see. It's liquid, fast, and levered. Physical gold, bars, vaulted inventory, delivery behavior, moves slower, but it reveals stress first through spreads, availability, and the way metal is financed. Most people only look at the headline print and ask up or down. The better question is, what does this price force participants to do right now? Because price is not a mood, price is a constraint. If you're a fund, a dealer, or a producer, price changes your required collateral, your hedging ratios, your VAR, and your ability to sit in a trade through volatility. And right now, the gold market is in the phase where constraints matter more than opinions. That's why you can see big down days that feel scary, while the underlying regime remains bullish. But that's not the part that matters. Here's the calendar trigger, the why now that turns structure into motion. We're in a window where contract rolls, delivery mechanics, and options exposure cluster into thin liquidity conditions. Late month. Post-holiday positioning resets. And critically, as volatility rises, the exchange's risk controls don't just respond, they can automatically tighten the screws. CME recently shifted precious metals margins toward a methodology tied to a percentage of contract value, meaning as the price rises, the cost of holding positions rises with it. That's not a headline most retail investors read, but it's a big deal because it changes how squeezes form and how pullbacks behave. It makes shorts more expensive as price climbs, and it forces over-levered longs to de-risk faster on dips. Translation? It increases the odds of violent shakeouts inside an uptrend, and it increases the odds of air pockets when liquidity is thin. That's the kind of detail that mainstream commentary misses because it doesn't sound dramatic. But it is dramatic, because if this one lever moves, the math changes. Now layer in the first proof point. The market has already shown you that it can absorb a margin-driven liquidation and still remain elevated. The late December drop happened after a record run, and it was tied to a very specific mechanical trigger, higher margins. And the market didn't to collapse into a multi-month unwind. It stabilized and re-advanced. That tells you something. There's a bid under this market that is not purely weak hands chasing candles. And that's where the real pressure starts. Second proof point, participation and positioning. When a market tops, because the story is done, you usually see participation fray in a particular way. Volume spikes on the top, open interest collapses, and price can't recover. But recent COMEX gold futures data showed a day where open interest was still north of 500,000 contracts, while open interest declined modestly and volume cooled versus the prior day. That looks like de-risking, not abandonment. It looks like some players taking chips off because the trade got crowded and expensive to hold, not because the macro impulse vanished. And that distinction matters, because de-risking can reload the spring. Abandonment breaks the structure, but that's not the part that matters. Third proof point, institutional pipes have been running hot. Gold ETFs saw record inflows in 2025. Figures around the high tens of billions of dollars globally, with commentary pointing to roughly $89 billion flowing into physically backed gold ETFs that year. That kind of flow changes the texture of the market. ETFs are not a fringe product anymore. They're a switchboard. When allocations surge, authorized participants create shares, and that creation mechanism can translate into real sourcing and hedging activity. Even if not every dollar equals immediate bar demand in a simple one-to-one way, the flow is a signal. Institutions and asset allocators are treating gold less like a trade and more like a position. Quiet behavior turned loud. And that's where the real pressure starts. Fourth proof point, central banks. This is the cleanest confidence shift signal you can get because central banks don't usually buy like momentum traders. They buy as reserve managers. World Gold Council data showed central banks buying over 1,000 tons in 2024, extending a long streak of net buying. And even in 2025, while the pace can vary quarter to quarter, central banks remained a firm pillar of demand with quarters like Q3 showing net purchases measured in the hundreds of tons. You can debate the exact motivations country by country, but the incentive is simple: reserve diversification. In a world where geopolitical alignment shifts, sanctions risk exists, and fiscal dynamics are noisy, gold is the reserve asset that doesn't require a counterparty's permission. You don't have to agree with every narrative to recognize the behavior. Behavior is the data, and that's the part that matters. Fifth proof point, physical custody and where the metal is sitting. London is a core hub in the global bullion ecosystem, and LBMA publishes monthly vault data. As of end December 2025, London vaults held over 9,000 tons of gold, up more than 2% from the prior month, along with a large rise in silver holdings too. The point isn't higher vault numbers means tighter or looser in some simplistic way. The point is that when confidence shifts, metal moves into places that function as collateral and settlement infrastructure. That's what vaults are, market plumbing. Metal doesn't just sit there like a museum exhibit. It's the base layer that supports OTC settlement, financing, and institutional custody. When you see shifts in custody patterns alongside major ETF and central bank demand, you're watching a system adjust, not just a chart wiggle. And that's where the real pressure starts. Now add a sixth proof point that most people ignore, the macro credibility loop. There's a reason gold is acting like a referendum on global sanity. When markets sense a combination of rate volatility, political risk, and fiscal stress, the confidence horizon shortens. People stop trusting that the next 6 months will look like the last 6 months. In that environment, gold doesn't need a perfect inflation story to work. It can rally in inflation, it can rally in disinflation, and it can rally in chaos, because the core demand is about neutrality and optionality. This is why you often see gold trade wrong relative to the simple textbook charts. It can rise even when the dollar is firming. It can rise even when yields aren't collapsing. Because the driver isn't a single variable, it's regime, and regime trades are sticky. But that's not the part that matters. The part that matters is how the structure turns regime into price discovery. Let's talk term structure for a second, because it's the fastest way to separate paper excitement from real tightness. Gold typically trades in contango, futures prices slightly above spot, because of cost of carry, financing, storage, insurance, and the opportunity cost of holding metal. In a normal world, that carry is boring. But when stress enters the system, the curve can flatten, roll costs can change, and nearby spreads can start behaving like a warning light. You don't need gold to be in dramatic backwardation to get the message. You just need to watch whether the front end gets bid relative to the deferred months when the market faces delivery and roll decisions. Because if the nearby contract starts commanding respect, if the spread tightens in a way that doesn't match normal carry, someone is paying up for immediacy. And immediacy is where confidence shift turns into inventory stress. But that's not the part that matters. Here's how this hits price in real life. Suppose gold is sitting around $4,500 to $4,600. That means every 100-ounce COMEX contract represents roughly $450,000 to $460,000 of notional exposure. If margins are set as a percentage of contract value, rising price mechanically raises the cash required to hold the same position. That affects everyone, but it matters most to the leveraged crowd. Fast money, CTA leverage, and anyone running tight collateral. And when price spikes, they can't just hold with conviction. They either post more cash or reduce exposure. That's why you get sudden downdrafts that look like the story broke, when in reality the collateral constraint tightened. Now flip it. If shorts are leaning into the move and price rises, their margin burden rises too. That can force covering, not because they believe, but because the cost of being wrong becomes too expensive. That's how squeezes happen in real markets, not by villains, by constraints. And that's where the real pressure starts. Now bring options into the picture, because this is where breakouts can go from slow grind to vertical candle. When price approaches big round number strikes, levels like $4,500 and $4,600, options positioning can create reflexive hedging. If dealers are short calls, rising price forces them to buy futures to hedge delta. If gamma is high, they have to buy more as price rises, which pushes price higher, which forces more buying. It's not magic, it's math. And when liquidity is thinner, around calendar windows after big news, during late session moves, that hedging can feel like the market levitating. Then when price turns, the same mechanics can accelerate a drop. This is why you must separate trend signal from noise. A big candle doesn't always mean new information. Sometimes it means hedging cascade. And that's where the real pressure starts. So what's the conflict force here? It's the narrative that says gold is just a fear spike. That narrative is comforting because it implies the world will quickly return to normal, and normal doesn't require you to rethink portfolios. But the market is hinting at something more uncomfortable. Confidence is being repriced, and a chunk of that repricing is structural. Reserve diversification, institutional allocation through ETFs, and collateral behavior in the bullion ecosystem. When those forces align, gold doesn't need you to become a gold evangelist. It just needs enough marginal demand to keep pressure on the system while leverage gets managed. That's a very different setup than a one-week panic trade, and that's where the real pressure starts. Now let's get brutally practical, because this audience doesn't want poetry. It wants what to watch next. The market has two clean scenarios from here, and both can be true in sequence. Scenario one is the controlled pullback and retest. In that scenario, gold can dip hard because it's expensive, crowded, and volatile, and still remain bullish. The controlled pullback would likely hold above the mid $4,300 zone that already acted as a margin event low in late December. Think of that zone as the line between forced liquidation and structural unwind. In a controlled pullback, you might see price slip under $4,500, probe the low to mid 4,400s, maybe even flirt with the upper 4,300s, and then stabilize as selling pressure exhausts and buyers step back in. The confirmation for that scenario isn't just it bounced. The confirmation is in the plumbing. Spreads behave, liquidity returns, and the tape stops reacting violently to every dollar move. The market starts making higher lows again, and that's where the real pressure starts. Scenario two is the continuation squeeze. In that scenario, gold doesn't give the dip everyone wants. It churns, it compresses, and then it pushes back through the recent highs in the mid 4,600s, forcing systematic players to chase and forcing shorts to respect the rising collateral burden. In that scenario, you'll often see the breakout happen in an inconvenient way. Overnight, or on a thin liquidity session, or right after a narrative-driven sell-off that failed to follow through. That's when the market feels unfair. That's also when squeezes are born. If price reclaims and holds above the mid $4,600, the next psychological magnet is not a specific target someone can guarantee. The magnet is the zone above the highs where options hedging can go reflexive again. The key is not guessing the top. The key is recognizing whether the market is in trend continuation mode or volatility trap mode. And that's where the real pressure starts. So what invalidates this whole confidence shift thesis? This is where we earn trust. First, if gold breaks down below that late December stress low zone in the mid 4,300s and can't reclaim it, you have to respect the possibility that the market is transitioning from regime rally to regime distribution. Not gold is dead, but the structure changed. Second, if institutional flow reverses in a persistent way, ETF outflows become steady, not just one bad week, then the marginal buyer may be stepping back. Third, if the macro confidence shock eases meaningfully, if uncertainty compresses, risk premia fall, and markets stop pricing chaos, gold can absolutely cool off. Some commentary has framed global sanity returning as the risk to gold, and that's not crazy. Gold can thrive on uncertainty. Reduce uncertainty, and you reduce urgency. That doesn't mean gold collapses to nothing. it means the pace can change. Fourth, if spreads and the financing signals normalize in a way that suggests no urgency for immediacy, that can also soften momentum. Invalidation isn't a single candle. It's a change in behavior across multiple layers. And that's where the real pressure starts. Now, the viewer psychology shield, because this is where most people lose money even when their thesis is right. The market will try to use volatility to make you betray your own plan. It will do it through 3 tricks. Trick 1, the headline whip. Gold drops 3% in a day and a dozen articles tell you the bull market is over. Then it rises 2% the next day and the articles tell you it's unstoppable. That emotional ping pong is designed by incentives, not by a secret meeting, to harvest reactive behavior. Trick 2, the margin narrative. When margin rules change, you'll see sudden flushes that feel like fundamentals shifted. But margin is not a fundamental. It's a constraint. Respect it. Don't worship it. Trick 3, the perfect entry myth. In a regime move, the market rarely gives you a clean, polite entry. It gives you ugly dips and then rips, or it gives you slow grinds that bore you into selling right before it moves. So the defense is simple. Decide what time horizon you're operating on. Define what is noise and what is signal. Use a 2-scenario lens so you're not mentally trapped in one outcome. And predefine your invalidation line so volatility can't negotiate with your emotions in real time. That's the shield, and that's where the real pressure starts. Now, the quick mechanism explainer that will keep you from getting played next week. Watch where volatility clusters. Volatility often spikes around delivery mechanics, roll windows, and big macro event risk. Even without naming every date, the pattern is consistent. As you approach the end of a month and into key futures logistics, liquidity thins, spreads get jumpier, and option hedging gets more sensitive. When liquidity is thin, stops get hunted more easily. When stops get hunted, price makes moves that feel irrational. They're not irrational, they're just illiquid. So if you see a sharp dip into the low 4400s and it snaps back quickly, that can be a stop run, not a breakdown. If you see price slice through $4,500 and it can't reclaim it for multiple sessions, that's a different message. Time matters, context matters. That's how you separate trend from noise. And that's where the real pressure starts. Let's make the near-term checklist brutally concrete. 1, watch the highs in the mid-4600s. If gold reclaims that area and starts holding above it on closing bases, you are back in continuation territory, and the market is telling you the bid is still in control. 2, watch the $4,500 handle. It's a psychological pivot, and it's often where options exposure clusters. Holding above it during dips is a sign of strength. Losing it briefly and reclaiming it quickly can be a volatility trap. Losing it and staying below it can signal that de-risking is ongoing. 3, watch the mid-$4,300 zone, the area associated with the last major margin-driven flush. If that zone holds on any retest, it suggests the market is still in higher lows mode. If it fails decisively, you shift from buy the dip regime to respect the downtrend until structure repairs. That's your map. And that's where the real pressure starts. Now, because this audience is skeptical, and it should be, let's address the suppression talk carefully. You don't need to claim illegal manipulation to see that gold is a politically sensitive asset. When gold rises, it can be interpreted as a critique of currency confidence and policy credibility. That creates incentives for institutions, analysts, and media to frame the move as transient, speculative, or irrational. That framing can be true sometimes. It can also be self-serving. The safer way to say it is, there are competing incentives around gold's message, and when incentives compete, narratives fight harder than facts. That's why you must anchor yourself to mechanisms, flows, margins, spreads, and behavior. Don't argue with the headline. Track what participants are forced to do, and that's where the real pressure starts. Finally, the payoff I promised. What happens next week? What level matters? What breaks if X happens? Next week, expect volatility to stay elevated, not because the thesis is fragile, but because the structure is tight. If price chops between roughly $4,150 and $4,600, that's digestion. If price pushes and holds above the mid-4600s, watch for a squeeze-like feel where dips get bought aggressively and the market becomes gap-prone. In that continuation scenario, your risk isn't missing the top. Your risk is getting shaken out by a sudden intraday flush created by hedging and thin liquidity. In the controlled pullback scenario, your risk isn't being early. Your risk is confusing a normal retest with a thesis break, selling the low and then watching the market recover without you.